And it's certainly the narrowing of the gap spread between Italy and Spain. That is something that has been very pronounced in the past week or so. Let's talk more with Peter Griffin, head of global risk assessment and sovereign fixed income at Global Interest Rates, joining us bright and early from London. Very nice to see you, Peter. So we've got the Spanish bond auction. Yeah, indeed. We've got this Spanish bond auction. Do you think we'll continue to see this decoupling between Spain and Italy, judging from the price action that we saw from the Italian auction yesterday?
Judging from the price action we saw from Italy yesterday and from the price action we saw last Thursday and Friday after the last Spanish auction, basically in terms of the Spanish-Italian spread, it continues to narrow. It's now at its narrowest since last February, I think, and I don't see any reason why it shouldn't continue to narrow. It doesn't seem, as everybody had assumed, that Spain would basically be affected by the instability in Italy and it would go the way of Italy, and as a result I think you could basically be looking to parity in terms of yields, even a crossover in terms of yields in the next weeks or months.
Yeah, but what does that really tell us in terms of fundamentals? Because one could argue that, yes, there's a banking scandal going on in Italy, but still Italian banks are far stronger, one would argue. Italy also enjoys a small surplus. So you can go on and on about why the fundamentals actually look better in Italy. Yes, there's a political situation
I don't think
going on, though. Yeah.
No, I completely agree with you. I don't think this has much to do with the fundamentals. This is simply political risk. It's simply what is going on in terms of Italy. If you didn't have the present stalemate, I don't think this would be happening. This all comes down to the uncertainty level in Italy. It's nothing to do with Spain.
Yeah, but in terms of fundamentals and market perception, isn't it just very odd that Ireland was actually able to come back to the table, come back to the markets, raise money, has fulfilled much of its needs for the year, and yet it's still rated by Moody's as junk? Who's getting it right? The markets? Markets or the ratings agencies?
I don't think markets ever get it right necessarily, do they? It is a mystery. The point about Ireland is it's carried through on its promises. It has a strong government which is in place and doing what it said it was going to do. If Italy had the same, I'd think you'd see a similar response to the Italian situation. It doesn't, so you don't.
So does this give leaders of the EU a message on which way actually works in getting an indebted nation out of its crisis? The example of Ireland. What message, if any, will that have on this EU summit and all along with the FinMin meeting that's going to be separately underway to deal with Cyprus?
It's a good question. Whether you could suggest they can use Ireland as the poster child, as has been said for a very long time now, whether that model is applicable at all to the Cyprus situation, I'm not absolutely sure. We're talking now about reducing the amount of the bailout for Cyprus to only, it's a tiny amount, 10 billion euros, and it's got nothing like the problems that Ireland had, and I don't think it necessarily calls for the extreme solution that Ireland has gone through.
Yeah. Maybe, do you think because of the budget battles happening across the pond, maybe one of the reasons why the great rotation isn't really materializing, and maybe it won't?
I've never believed this great rotation thing. I mean, the great rotation would basically have more legs as a theory if we weren't, when we're touching all-time highs in US equity markets, at the same time on the 10-year, we're just barely above 2% in the yield. In terms of what PIMCO said earlier in the year about the fact that you are just not seeing money emigrating out of bond funds and into equities. You are seeing it emigrating out of cash and out of money market funds and into equities, but also into bonds. I don't think there is evidence of a great rotation, and even if there were, and this I suppose is my most important point here. Even if there were, if you look at a chart of the T-bond going back 32 years, we've seen this nice, gentle movement up to where we are now, and there's no reason to assume that basically as people migrate out of treasuries, you won't see the nice, gentle movement downwards again. Bonds just simply don't act in the way that everybody seems to be assuming they do.
Right.
They're not equities. They don't have that degree of volatility.
Yeah, indeed. Certainly a curious picture that we continue to see. We'll keep on talking next time. Thank you so much for making the trip today. Peter Griffin from Global Interest Rates. And he's on my Twitter handle as well. You can get in touch with him if you want to ask any questions. And let's find out what's happening in Paris. Stefan joins us with the very latest. Good